We are, make no mistake, the middle of an enormous multivariate kind of Ponzi scheme.
When you think about a Ponzi scheme, you typically imagine a Bernie Madoff type character, or maybe a BitConnect character.
Hey, hey, hey!
It's one guy selling an impossible investment to a bunch of suckers.
Bernard Madoff has just been sentenced for the biggest investment fraud in Wall Street history. Madoff pleaded guilty to 11 felony counts of securities fraud and perjury in a Ponzi scheme that robbed thousands of unwitting investors of tens of billions of dollars. Many of them lost their entire life savings.
The thought of something like the epicenter of innovation that is Silicon Valley being a giant Ponzi scheme doesn't really cross your mind.
We've got an incredible opportunity to try to uphold a legacy in Silicon Valley of changing the world. And
disrupting the world.
We're working 24/7 to do it.
Well, I understand.
And that is perhaps exactly why Silicon Valley and the world of venture capital has been able to slip under the radar and grow to be perhaps one of the biggest Ponzi schemes in human history.
I'm sorry, guys, but if you think that that's not what's happening, you're lying to yourself. You are lying to yourself.
And here's how you can profit from it.
Any Ponzi scheme, so to speak, like the people who are actually running it, they would almost never really think that it's a Ponzi scheme in any way, either through lying to themselves or simply by looking at other examples of things where people don't call it a Ponzi scheme.
This is Arvid Ali. He created one of the most successful consulting firms in Silicon Valley and is currently president of Jordan Belfort's companies.
For example, your video on how the banking world works. In some ways, it does genuinely operate like a Ponzi scheme if you really think about it. So it's taking a bunch of people's money and then lending it out to other people and then trying to get more money from the people that they lent it out to, and then they just keep moving money back and forth between their different customers. It's not inherently that different from most Ponzi schemes as it relates to investments. It's just a slight little tweak that converts it from being a legitimate, banking service versus being a Ponzi scheme, if that makes sense.
If you're gonna build your own VC firm or be a business person in general, you're gonna eventually need to work with people from all over the world in our ever more connected economy. That's why this video is proudly sponsored by Babbel, the #1 language learning app in the world with more than 10 million subscriptions worldwide. This is the app I use, and it really does make learning another language enjoyable and easy. And it definitely helped with the Russian Mafia video.
Niet.
You can choose from 13 different languages, you can learn in easy to digest 10 to 15 minute chunks, and what's unique about Babbel is that universities have shown that just 21 hours on Babbel is equal to an entire college course at pennies on the dollar. Stick to the end to learn more, or pause the video and click on the link in the video description to get up to 65% off a Babbel subscription for a limited time only, with a 20-day money-back guarantee. That's up to 65% off with the link below. It all starts with an idea, a new app, a new platform. Preferably from young, naive, not business-savvy founders. But not just any idea. A disruptive idea, an idea so good that it will for sure turn this industry upside down, the next Uber of whatever. Or at least that's what the entrepreneur hopes. Maybe in reality, it's just an okay idea. Maybe in reality, it's a terrible idea that will never be profitable. But that's besides the point, you just need it to sound like a disruptive tech startup. Because tech startups have the allure of being able to grow super fast, where you can double, quadruple, 10x, 100x your investment. But in reality, you're really just bringing in existing technology like a pretty website and mobile app into an existing industry. So the founder manages to get the startup going, but they run into a problem. Their revolutionary idea needs a lot more upfront capital to get to the next stage. Maybe they're worried that their idea is so good that bigger companies with more money are just gonna take their idea and outspend them. Or maybe they just want to make it big, get rich, get famous fast.
It's reasonable to compare you, I usually don't do this, to Steve Jobs and what he did for computing.
Whatever the reason is, they need money. But banks are never gonna give business loans out to risky startups. Something like 3 out of every 4 startups fail. Banks are never gonna take that kind of risk. Luckily, that's where we come in, the venture capital firms, or VCs for short.
So what you'll often find is that VC firms really specifically want to invest into companies where the founders are really young guys, is because they want them to essentially act as slaves for them. So what you'll find is that these founders are working all day and night to effectively act as these slaves for these firms who dictate exactly what they need to be doing.
So So step number 2, you come in and say, hey,
We want to partner with you. You're the best. We're going to help. You're so awesome. Have a fleece fest. We backed blah, blah, blah company. You know, right? That's that's the pitch.
So you start to court them, but not as an individual investor that's putting their own money on the line.
These are not people writing checks out of their own balance sheet. They're doing a job with other people's money.
No, you're what amounts to a fund manager who knows a lot of rich people. Rich people who don't like having a bunch of cash on hand since it just goes down in value. So they give a tiny portion of their cash to VC firms like yourself, in hopes that you'll invest their money in the next big thing, startups that will give them huge returns that they're never gonna find anywhere else. In exchange for a fee, of course. Here's how it works. Investors hand the VC firm money to be locked up in the fund for 10 years or more. The fund managers collect a 2% fee on the amount of money under management per year for the first 4 years, also known as the active investment period, which may or may not be all that active. Then they take around a 1.5% fee for the remaining 6 years. So if you raise a $100 million fund, you're guaranteed to make a minimum of $17 million. No matter if the companies you choose go up, down, sideways, whatever. $17 million practically all going into your pocket since there isn't much overhead.
All the money pretty much goes directly into the pockets of the people running the VC firm. So it's often the main person who created the firm, as well as the partners that he or she brought in, and a little bit goes to the few employees that they have. The reason they barely have any employees is because the work that they actually have to do is next to nothing. It's very typical for many of the employees to become millionaires very quickly.
But on top of that, even if you're just randomly picking startups, some of them are bound to do well. And if they do, you get 20% of those gains, also known as the carry. If 1 out of every 10 startups you choose does well, you take from the top and leave the losses for your investors to carry. So back to step 1. You offer the startup, let's say, $1 million in exchange for a percentage of their company. We'll call this the Series A funding round. Along with the $1 million offer, you put the valuation of the startup at $6 million, meaning that a $1 million investment at the valuation of $6 million gives you around a 17% ownership in the company. The startup gets $1 million to grow faster, the founders feel great because they built $1 million company, you and your investors get a share in an early stage startup that could make it big, but perhaps most importantly, you collect those juicy management fees on that $1 million invested. And then comes the first board meeting with your new company, and you ask,
So how fast are you growing? Okay, grow faster. How many of you have had that discussion? Grow faster. Okay, most of you that raised your hand.
just grow faster? Yes, we want to see massive growth. Okay, but we were kind of hoping to improve the product a little more before we go after a larger audience. Nope, it's good to go. Massive growth. Got it? Okay, well, these investors know what they're talking about, so the founders take your money and grow faster. Step number 3, grow super fast. The founders take the millions you gave them and shove them into things like Facebook ads, Instagram ads, YouTube ads, Amazon services.
It would probably shock you to know that almost 40 cents of every venture dollar right now goes right back into the hands of Google, Facebook, and Amazon.
Basically, you get them to do whatever it takes to grow on paper, because that's all that matters.
You think that's all profitable growth? No. That's there to fund your superficial growth.
More users, more sales, more revenue. Don't worry if the company isn't profitable or sustainable. Don't worry about things like whether or not the product is actually getting better, if the product market fit is actually getting better. Don't worry if it costs $100 to acquire a new user when it only brings in $10 in revenue each. Just spend as much money as possible to get more customers, more growth. We'll figure out how to be profitable later.
Just because the entrepreneur or the VC gives you $1 million and tells you to grow faster, do you have better product market fit in that moment? No. You're doing what you're told to do, which is to take their money and make the company grow.
Remember, we want to keep the illusion going that this is one of those disruptive tech platforms that have to be unprofitable before they can skyrocket in money, like Amazon or Facebook.
But in reality, what's really going on is they take advantage of that narrative by simply saying, hey, let's make sure that we have absolutely no profit, and let's just show that we're getting a lot of users the same way that Instagram or Facebook got users. And as long as we're showing that engagement growth, then we'll be able to raise a lot of money. The problem is the second we show any profitability, that happens, they'll bucket us as a normal company and not a hyper growth company. So the funny thing is, like, I know a lot of Silicon Valley companies that are worth well over $1 billion. And when I speak to the founders, what they'll say is, The second the company even starts to turn a profit, the VC firms will say, hey, don't ever show a profit immediately, show that you're running at a loss, because we can't ruin the narrative that it's a hyper-growth company.
Which brings us to step number 4, running out of money. So a year or so passes by and the founder spent all your money. But look, the startup you picked grew their user base by 400%, their sales skyrocketed by 400%. So you, the VC, are thinking to yourself, man, I'm pretty good at this. I gotta tell my friends, hey VC Bob, look at this startup I just invested in. They're gonna be the next Uber of one-night stands, and guess what? Since investing in them, our investment has grown by 400%. Dude, you gotta get in on this action.
They turn around to their buddies and say, look at this thing, it's growing. You should do the B.
So you go back to your board meeting and say, hey guys, good job. But if we want to keep this train going, we're gonna need to raise more money.
And then they come into a board meeting, they're like, guys, I think we should raise a B.
Which brings us to step number 5, the Series B round. When you invested, that was called the Series A funding round. The second funding round a startup goes through is logically called the Series B. So your pals in another VC fund throw in a few $1 million of their investors' money to secure their spot in the company. You and your VC friend agree on an even more ridiculous valuation number to make yourselves look good, and in the next board meeting, VC Bob asks, hey, how fast are you growing? Oh, okay. Take this money and grow faster. So 40 cents of every dollar from the Series B money also gets thrown into Facebook, Google, and Amazon to buy more unsustainable growth.
It's not even clear that those LTVs and those CACs make any sense. Doesn't matter. You've been told to grow. So you're growing, you're doing your job.
Which leads us into step number 6. Another year or so passes by, and would you look at that? We're all out of cash. But hey, we just had another fantastic year of growth. So VC Bob is also led to thinking that, man, our investment is doing so well, but we need more money to keep it growing.
We should raise a Series C, we're running out of money. Well, of course you are, because 40 cents of every dollar just went back into the hands of Facebook, Google, and Amazon.
So your friend VC Bob shows off their returns to their friends in another VC firm.
That buddy is like, yeah, this looks great. Boom, fire the money in.
They raise a few more millions for the Series C funding round, completing step number 7. And throughout all these funding rounds, since all the VCs are buddy-buddy, they can value these companies at whatever valuation they want. The higher the valuation you guys make up, the higher your paper returns look to attract more investors, the higher the net worth of the founders' investors.
The guy that started the company, he's very happy. He's like, never even knew if he could ever grow a business or something like that. And all of a sudden now he's got this business that, who knows, might have a valuation of hundreds of millions of dollars or $1 billion. And he's got, a 10% ownership, 20% ownership in this. He's incredibly happy. He just got insanely rich.
And as long as you guys can convince the public of this valuation by the time the company goes public, the higher your payday when you cash out. So your goal is to make up the highest possible valuation that the public is willing to believe. Why do you think WeWork was valued at over $40 billion at its peak?
The best case scenario is for them to be so large that they end up going public. What you're trying to do is push it off so that the general public is dumping their hard-earned money into your business, either through the standard IPO process or more commonly nowadays through the backdoor process, being the SPAC.
So back to our Series C funding round.
Now A has an even better markup. B has a markup. C has a basis and is like, hey, how fast are you growing? Maybe you should grow faster.
Which brings us to my favorite step, step number 8, look like a genius. See, when you invested, you guys settled on a valuation of $6 million. Well, by the time the second VC firm invested, the company grew by 400%. So Bob's VC firm settled on a valuation of, let's say, $24 million. That means to you and your investors, in just 1 year, you 4x their money on paper. So you're feeling pretty smart right now. I'm practically the Warren Buffett of startups.
The guy who runs Fund A is like, I should raise a second fund. I'm pretty good at this. And goes to a bunch of investors and says, look at my IRR, they're amazing.
So for step number 9, you start a second fund to invest in more startups, to have more money under management, collecting those juicy management fees, starting the process all over. Except this time, instead of raising money from your rich investor friends, you have a track record. You can now target even bigger investors, institutional investors like pension funds and endowments. Maybe for your first fund, you raise a puny $10 million. So maybe for your second fund, you're able to raise $50 million, $100 million. By the time the Series C, D, E comes around for the original startup, and all the artificial growth that comes with it, your friend Bob in the second VC firm that got in is also feeling pretty confident. It would be a waste not to put your Midas touch on more startups, so VC Bob also starts another fund to start the process all over again.
And then somewhere between the C and the D, the B guys are like, I'm pretty good at this. This is easier than I should raise a second fund. Maybe I'll make it a slightly bigger fund. I should be doing bigger checks.
Which brings us to the final step, the exit. A few years have gone by, the founders, all the VC firms that invested in the Series A, B, C, D, E, and so on have made a ton of money on paper. And if they want to cash in on all those earnings to realize those gains, they can either sell the company to one of the big dogs, Facebook, Google, Amazon, and the like, which isn't optimal. You're not going to get as much money out of that, but it's better than nothing. Or they can take the company public, which is where the real money is at.
The idea is to get so large that it's not really reasonable for most companies to even be able to acquire you because the valuation is insane. So if you can't, then the best thing you can do is to get acquired. But the only problem with getting acquired is that there's only some set of companies that have the money and interest in acquiring you. So
if you can exit and cash all your earnings, great. You'll get a part of that money from selling the company, 20% of the gains. Your investors will get the rest, and everyone is happy. If, however, the company goes under and you guys can't sell the company, also great. Sure, you won't get the bonus from the exit, but hey, you've been collecting the management fee as the fund managers this whole time. You don't feel any of that loss. But for your investors, 3 out of every startups fail. It's no big deal. One of the other startups we have your money and will make up for it, don't worry. So whatever happens, everyone is happy.
This is what's happening now. So when you wake up every day and you notice that umpteen companies are getting funded for every single idea, and then that the quantum of dollars are going up, and that all of a sudden you're reading about investors you've never ever heard of, that is what something like this looks like played out in real life.
But there's one fatal flaw in this entire scheme. The only reason this whole thing worked is not necessarily because it was a great company, a great idea, or great execution. After all, most of these companies are just regular businesses sprinkled with a little tech. But because of the same reason why any Ponzi scheme works. The money kept coming in. The more money came in, the more unsustainable growth could be bought from Google, Facebook, and Amazon.
These are fundamentally broken business concepts. They don't work. They only work if the money never stops.
The more growth that was bought, the more investors it attracted, the more funds were started.
It's just a little Ponzi scheme, but think about it. If any way along the money stopped coming in, the business failed.
The higher the valuations are set, the more money the people who got in early in this game of musical chairs made.
Johnny Private Equity was the only thing that kept it alive so it could grow even more at a huge faster rate, which would push up the valuation even more. So these guys all look like geniuses and they all make their fees on it.
But as soon as the day arrives where the money stops coming in, the music is gonna stop, and whoever is left without a seat is screwed.
Let's say this guy couldn't grow any more money. Let's say Johnny Private Equity didn't want to buy in. You know where this goes? It goes to bankruptcy. It goes to zero. The valuation goes to zero.
But the money never stops until as much time as people can raise new funds. And that's predicated on people marking up old deals.
Why is all of this happening all over the startup scene right now as we speak? The same reason why any other corruption happens. The incentives.
Generally speaking, the actual employees themselves, as well as the founders of these companies, have absolutely no idea. What's funny is, even for me, I actually had no idea that this was going on, despite the fact that I worked with hundreds of Silicon Valley companies over many, many years. I couldn't even get a sense of that, because all you see is these people working so hard. And how could you ever think that all these people working so hard to build a product and to get customers, that what they're building is useless, isn't a real business? So you never really think that once you're inside of the bubble, but the second you leave that bubble and you get into the mindset of the financial industry and you actually create a VC firm, that's how I came to terms with what's really going on. And then I verified with some billionaires in the finance industry, and that's kind of when I got a perspective on what was really going on.
After the VC managers place the money into startups, there's not really much to do. On top of that, it doesn't matter if growing at 400% isn't sustainable, because by the time the company runs out of artificial growth to buy, the VC firm will be out of their cash in hand. That's why the game is more about placing your money than finding the best startups to invest in.
You see how this whole thing, like at no point is there anything that comes back to you, the entrepreneur, that says, what's your true core product market fit and is it working? It's not part of the conversation. That is extremely dangerous.
Now, the majority of people in the VC world aren't aware this is what they're perpetuating. For the most part, they're just doing what they see as the best choice for them in the moment. Is this a bubble and is it gonna burst? It's hard to say.
But the reality is people are greedy.
It is a very large bubble, but it's impossible to say whether a bubble is actually ever going to pop, or even if it does pop, whether it pops in a meaningful enough way to stop the practice. So if you really look at a lot of industries that have typically had bubbles, let's say real estate, especially with the housing market, even when the bubble like temporarily contracts, there's usually enough incentive for people to keep going on with the trades. What allows people to keep the housing market the way it is now, it's still ridiculous. The prices of homes have no bearing on reality because people are able to get 30-year loans that they need to spend an entire lifetime paying back. So it doesn't make any sense. Same thing with higher education. These bubbles, yes, it'll contract, but the problem is that there's a psychosis in society that's so extreme to say that regardless of the price, this is such a valuable thing to do that I'm just gonna go ahead and do it. So in the startup world, in people's mind, they're thinking like, oh, if only I got a chance to be one of the early investors in Facebook, I would be a millionaire or a billionaire right now. So that notion of gambling and that sexiness to it is so alluring that I don't really foresee that the bubble will completely, burst in any specific way.
Am I or any of my affiliates calling VC firms, Silicon Valley SPACs, or whatever directly a scam? No, so don't sue me, bro. All I'm trying to say is that we all dream of getting rich quick, which is legitimately possible. But this is a gentle reminder that the grow at all cost mentality can be dangerous, and that real growth is always better than paper growth. So obviously, the only logical next step is to start your own VC firm. That's what I'm gonna do, and it's gonna be called Tran Capital. Invest now. If you do start your own VC firm, or if you have any big business aspirations whatsoever, you're probably gonna have to talk to rich people who have money to invest, but are maybe from out of the country, a foreign investor. Maybe their English is not too good. Maybe their English is good, but it's not their native language. So if you really want to wow them, if you want to instantly stick out from the masses of people always asking them for money, speak their native tongue. Hell, learn just a few phrases like hello, thank you, and watch their ears instantly perk up with a smile on their face. Why? Because where everyone else is thinking, what can I get from this person? You show them that you care enough to go out of your way to learn their culture. This doesn't just apply to selling yourself to investors, by the way. It could be the mentor you want, the girl's parents, the employer you want to wow. And that is why I am very proud to have Babbel as a sponsor of this video. The #1 language learning app in the world with more than 10 million subscriptions worldwide. You can choose from 13 different languages, and it has a 4.5 star rating from over 750,000 reviews on both the Google Play Store and the Apple Store. And where Babbel really shines compared to other language learning apps is that instead of wasting your time learning words you'll never use in real life, Babbel gets right into the meat, teaching you phrases you'll actually use in real life. And for a limited time, Babbel is offering you aspiring international business people up to 65% off a Babbel subscription. So you can start learning a new language right now in bite-sized 10 to 15-minute chunks with the link below. And they have a risk-free 20-day money-back guarantee. So get up to 65% off right now by clicking the link in the video description. Guys, huge shout out to my friend Arvid Ali, who you've seen like sprinkled throughout this entire video, because without his help, this video definitely wouldn't have been possible. Arvid is also a pretty sharp guy. He's the current president of Jordan Belfort's companies, yes, the real Wolf of Wall Street. He's an advisor to like 50 celebrities, billionaires, corporations, and prior to this, he built one of the most successful consulting firms in Silicon Valley. So he was the perfect person to help out with this video. He just created a YouTube channel of his own where he's going to be going over more secrets that he's learned as a true insider. So if you enjoyed this stuff, show him some love from the Tran Mafia family by subscribing to his new channel with the link below. While you subscribe to his channel with the link in the video description, you might as well subscribe to this channel too if you are new here, because we make video essays just like this one every single week on the most provocative, thought-provoking stuff in the world of business. Instagram, we have a lot of fun over there. You can follow me at jaketrend.io if you want like memes, behind the scenes stuff, me complaining about stuff, and cool quotes that I come across in my own research that you're not going to find anywhere else. That is going to wrap it up for this video. Thank you so much for watching. You've been awesome. I've been Jake. Stay dangerous out there, and I'll see you guys in the next one.